If you've ever tried to get a real handle on, global finance, chances are you've run straight into this thing called the Forex market. And if you're like most of us, you probably just felt instantly overwhelmed.
Oh, absolutely. It's true. The moment you search what is Forex online, you just get hit with this wall of jargon. It almost feels like it's designed to keep you out. You see words like decentralized, leverage, liquidity. It makes the whole thing feel incredibly complex. And yeah, totally overwhelming.
That is exactly the confusion we are here to cut through today. Our mission, really, is to strip all of that away. We want you to understand what Forex fundamentally is, why it's so important, like the engine of the whole global economy, and how it can be the biggest financial market on Earth while staying almost completely invisible.
Right. We've pulled together some great sources that break this down, and the goal here is to give you those aha moments so you can walk away from this deep dive actually feeling like you get it, not just, more confused.
Okay, let's do it. Let's start by tackling that complex definition, the one that makes everyone's eyes glaze over. You know the one. Forex is the decentralized global market where currencies are traded in pairs with leverage and liquidity. Hmm. I mean, might as well be in another language if you're just starting out.
It just creates this unnecessary barrier to entry.
But the simple definition, it's so much easier. Forex is just short for foreign exchange. At its absolute core, it is just the system where people exchange one country's money for another country's money. That's it. That's the simple truth.
And the funny thing is, you, the listener, you have definitely used this system, probably many times, without ever realizing you were tapping into the world's largest market.
Yes. Let's make it real. Think about going on holiday. If you're from the UK and you're going to Spain for the weekend, you need euros. So you take, say, £100 to the currency exchange. They swap it for maybe 115 euros. That little transaction right there, that's foreign exchange.
Or something even more common now, buying something online from a US website. The item is priced at, let's say, $50. You just click buy with your British debit card. And instantly, behind the scenes, your bank does the exchange. It converts about, £38 into $50 to pay the seller. That is the core of foreign exchange in action.
So the action is the same, getting cash for a coffee in Madrid or buying software from Silicon Valley.
Exactly. And this brings us right back to some of that jargon we wanted to demystify. When you do that simple transaction, you're relying on two really big ideas: liquidity and leverage.
Right, the words we called overwhelming, so let's make them approachable. What's liquidity in this context?
Liquidity, in simple terms, is just how easy it is to buy or sell something immediately without the price changing much. And in the Forex market, because over 5 trillion pounds is traded every single day, the liquidity is just immense. It means whether you want to exchange 100 pounds or 100 million, there's always someone on the other side of that trade, instantly.
So that huge volume is what makes it stable and accessible for, well, for everyone.
Precisely. Now, leverage is a bit different. It's more for the traders than for, the person buying a souvenir. Leverage is basically the ability to control a large amount of currency using only a small amount of your own money. You're trading with borrowed capital. It magnifies your potential profits, but, and this is the critical part, it also magnifies your potential losses. It's a powerful tool, but it's very risky.
Okay, that context is so important. So we go from personal stuff swap and cash for a holiday to the bigger picture, why this entire system has to exist. It's not just some artificial playground for traders. It's the oil and the engine of global trade.
This is the key shift in understanding. It's a necessity. You see it when you look at any big multinational company. Think about a German car company like Mercedes. They build their cars in Germany, right? They pay their workers, their suppliers, all in euros. But they sell a huge number of those cars in America and get paid in US dollars. Well, they can't pay their German workforce in dollars. They have to constantly exchange those dollars back into euros just to make payroll.
And it's not just companies. I was surprised to see it affects the governments just as much.
Oh, absolutely. Think about government debt. Let's say the British government borrows money from China, and that debt is in Chinese yuan. When it's time to pay the interest on that loan or repay the whole thing, the UK government has to go into the market and exchange massive amounts of British pounds for Chinese yuan to make the payment. It's constant, it's unavoidable, and it's essential.
So these huge necessary exchanges are happening all the time, which is why the market moves. But what makes the rate itself go up and down? That's where the trading part comes in, right?
That's the $1 million or $5 trillion question. The short answer is supply and demand, and that's driven by huge economic factors. So, for example, if the UK's central bank raises interest rates, it suddenly becomes more attractive for global investors to hold British pounds to earn that higher interest. So, demand for the pound goes up, its value strengthens against, say, the dollar, and the exchange rate moves. It's all connected to big economic news.
That makes so much more sense.
Yeah.
Which brings us to what might be the most surprising part of this whole thing, the sheer scale and the invisibility of it all. Everyone knows about the stock market. You see the building on the news, the ringing of the bell, but Forex, it's like a ghost. Why?
It all comes down to their structure. Stock exchanges, like the New York Stock Exchange or the London Stock Exchange, they're centralized. They have a physical location, a trading floor. We can picture them.
Yeah, they feel tangible. You see them in
Yeah.
movies.
Exactly. Forex, on the other hand, has no address. It's completely decentralized. It's just a vast electronic network connecting major banks, corporations, and governments all over the world. It happens everywhere at once.
And the size difference is what really hammers home this idea of the silent giant.
Mm.
I mean, if you add up all the stock markets in the world, they trade something like, what, 200 billion a day?
Roughly, yeah. On a busy day, Forex trades over 5 trillion pounds every single day.
25 times bigger. It's staggering.
It really is, and that's why we call it the invisible giant. It dwarfs everything else but happens in the background.
Okay, but that raises a really important question for me. If this market is so huge, 5 trillion pounds a day, but there's no central building, no single boss like the SEC watching over everything,
Yeah.
how does it not just, fall apart? Doesn't that lack of central control create some kind of huge risk?
That is a fantastic and fundamental question when you talk about decentralization. And the answer is a little counterintuitive. The safety doesn't come from one single regulator. It comes from the participants themselves, the huge global banks, and from the sheer volume, which brings us back to liquidity. Because there's no central clearinghouse, the risk is managed between the banks
Yeah.
through very strict agreements and international regulations, like the Basel Accords, which control how much capital they have to hold. In a weird way, the incredible scale provides stability. You can't just crash a 5 trillion pound a day market like you could crash a single company's stock.
So the decentralization is what allows it to be so massive, and that very massiveness is what sort of paradoxically keeps it stable.
Precisely. The major players are the infrastructure.
So let's talk about one last thing that comes from this global decentralized structure, the trading hours. This market is open 24 hours a day, 5 days a month. It literally never sleeps during the week.
And that's purely because of time zones. It's quite elegant, really. As the big London session is winding down in the afternoon, the New York session is in full swing. Then, as New York starts to close, the Asian markets, Tokyo, Sydney, are just opening up for their day, and then they hand it back to London. The market just follows the sun around the globe.
Now, for someone new to all this, that 245 availability sounds amazing, right? They're like, great, I can trade whenever I want.
Yeah.
But our sources were really clear that this is a huge psychological trap for beginners.
It is an enormous trap. It creates this constant pressure, this fear of missing out, or FOMO. If you're just learning, you might look at the charts at, I don't know, midnight and see a tiny little movement and think, oh my God, I have to get in now or I'll miss the big one. This feeling that you should always be watching, always be ready to act is just relentless and exhausting.
It sounds like the financial version of being on call 24/7.
It is. I remember reading one account from a new trader who said he was waking up at 3 a.m. to check the Tokyo session because he was convinced that's where all the action was. He ended up just losing money because he felt he had to be doing something.
So the crucial and kind of counterintuitive lesson here is that availability is not the same as opportunity.
That is the single most important lesson.
Absolutely.
Just because the market is open does not mean there are good, high probability opportunities to trade. You might be watching during a period when it's completely flat and quiet. Maybe it's a bank holiday in the US, or it's that late night lull between New York closing and Tokyo really getting going. Trying to force a trade when there's no real movement is just a recipe for frustration.
So the real skill isn't about constant action. It's about knowing when to do nothing.
Correct. The real skill is about understanding the bigger economic picture and having the discipline, the patience to wait, to choose when not to act. That's what separates the pros from the amateurs.
Wow. This has been a really insightful look into a system that feels like it's deliberately confusing. We went from that overwhelming jargon to the simple truth. It's just currency exchange. We figured out it's a central role. I mean, it's the bedrock of global trade. And then we uncovered that staggering invisible scale, over 5 trillion pounds a day.
It really is the foundational mechanism. Without it, the whole interconnected global economy would just seize up. It allows everything to function across all those borders and time zones.
So what does this all mean for you listening at home?
Well, here's a final thought to take with you. The next time you see a news report and they mention the exchange rate between the pound and the dollar has moved a little bit, just remember that 5 trillion pounds is changing hands every single day. Think about how those tiny fractional movements ripple out to affect everything. They change the price of the coffee beans that were imported for your morning cup. They change the cost for your government to repay its international debt. And they have a massive impact on the profits of every major company you can think of. This constant, gigantic, invisible flow of money is happening right now, shaping the world around you in ways you'd never expect.